What's going on, everybody, and Happy New Year. It is I, Charles Moon, the disciple of trend, with the great and legendary Howard Greenberg of the Crypto Crew and co-host of the Dips to Rips podcast. My man, HG, Happy New Year. How are you doing, man?
I'm doing well, Charlie. Happy New Year to you also. How is everything with you?
Well, you and I both, not to fully disclose everything, kind of had to deal with some, family emergencies, but, thankfully everything is good. And now we're back to getting back to the grind, so to speak, but we got a little bit of rest, but I'm glad you did as well. Staying in the great and exciting state of,
Yeah, that's not where everybody doesn't head to Dayton, Ohio for New Year's. You didn't know about the rocking time? Sure, you're getting me in trouble, Charlie. You're getting me in trouble.
No. Well, let me know something. I hope your beautiful girl realizes how much you love her, considering that you went to Dayton, Ohio.
I did, and I'll do it again in a second. It was a great time.
Yeah. So new year, new me, new year, new markets. Howard, what do you think? Let's talk about
new year, markets. Same damn markets.
For you. For you.
Oh, yeah. I mean, so yeah, I mean, the biggest news would be we hit our first short squeeze, basically since mid-December, since December 14th. So it was nice to see us get a little bit of volatility and move up. Took all the alts with it. Bitcoin was trading sideways nicely, which was giving some air for the alts to breathe. One of the great things about Bitcoin when it trades sideways is that's really when the alts shine, and we get to see some movement up and down from the different alts because there's a little bit of liquidity. But when we see Bitcoin jump up like we did, yesterday from 16.6 to 16.9, what you tend to see is it eats up all the liquidity. And it sort of slows down. So all the alts that were making some nice moves all stalled out as Bitcoin took off.
Yeah. So that makes total sense. And you had a thesis about that today because you obviously called out a few trades. And, obviously that's the breakdown. That's the context as to why you are positioning yourself the way you are. That just shows that you not only talk about it, you be about it. So there is some news in the crypto world. The Solana move is very exciting for one. Obviously with Silvergate being in the news, but Grayscale is the more, I guess, concerning factor here. There's a lot of new. Can you kind of enlighten the crowd what the hell I'm talking about? Because I don't want to sound like I'm really smart and know what the hell I'm talking about. Instead, I want the expert to say it here.
So there is a company called DCG, which is Digital Currency Group, and it's led by Barry Silbert, former, I think, Goldman guy. But they are, the Grayscale Trust, which is the largest holder of Bitcoin in the world. They are also CoinDesk, the news, television, radio, and web station that they do. But they are also something called Genesis, and Genesis had a trading desk, and Genesis had a lending and borrowing desk. And that's the one that really comes into concern. And the lending and borrowing desk got hurt really bad first by 3 Arrows Capital, who, defaulted on a large amount of uncollateralized or under-collateralized loans.
To say the least.
And the parent company, DCG, bailed Genesis out. And then just recently, again, with FTX, they got hurt again. They had a lot of funds on FTX, and they paused withdrawals. And they've kept them paused for a long time. And where that really became even a bigger issue is that Gemini, the exchange that the Winklevoss brothers, run, it had a program with them for their Gemini Earn program. And about $900 million is locked up right now within Genesis, DCG, however you want to look at it. So the Winklevi brothers there, they came out and they called out Barry Silbert and DCG directly on Twitter and said, hey, you guys made this shady loan to yourselves. You owe yourselves the money. Because basically it said that another entity of DCG owes Genesis that money. There's a promissory note from the parent company.
Right.
Pay out the 900 million. Yes, it will hurt you, but it will make whole, these thousands and thousands of people, and you'll get through it when you can restructure and you can still survive. Silber came back and said that, they haven't defaulted on any of the interest payments that are due on the loan. There's nothing else due coming up. So that since that really isn't the issue, that issue didn't cause why we've paused withdrawals. So that's why they don't feel they owe it. So it's been a pretty big battle. The big part there is, again, a few different concerns, with the holdings of Genesis and DCG and all this. Are they going to have to sell off some of these holdings? The magic, sort of jewel there is the Grayscale Trust, which earns a tremendous amount of money, hundreds of millions of dollars in fees a year that are locked in. It's like one of the most captive things in the world, because you can't reclaim or redeem your Grayscale Trust. So it's just there, and they get 2% a year of it in perpetuity, basically, for managing it. So, a lot of stuff going on there. Do they go down? Do they have to sell a large amount of Bitcoin or other assets? People have been looking at the other things they own. And that's definitely put some more, risk of downside in the market.
So, I actually succinctly recall that we had a conversation about FTX and a few of the other kind of, larger brokers and exchanges having major issues, especially withdrawals. And we've ended up finding out why. And I remember during that podcast and the one after that, you actually were warning people about this DCG, and you were warning about follow-up issues. And now here we are, they're pausing withdrawals. So, once again, Howard, you're doing, God's work in an extremely positive way, because this is now the third or fourth time that you have warned people, our listeners, our clients, and people that follow us, and it's literally come to the worst case scenario every single time. So much love, man. HG. Thanks, HG, you're the best, dude.
Thanks, buddy.
So this new year, crypto market's getting off to decent, at least Solana is looking really damn good. When you show me that chart, I respectfully haven't been tracking, but that's because I've been putting a lot of time into stocks. I really haven't had much time, and whatever free time I've had has been stocks in preparation for the new year. The preparation for the new year, it might be different for crypto. It's for sure with stocks that big money positions themselves, right? They liquidate, they reposition, and then you can kind of get a feel and guidance for how the market is being played or being speculated upon by the big money very early on, what sectors are really kind of gravitating towards and accumulating, and maybe some that they're dumping or fading. And last year, I believe we gapped open up. We had a strong up day. We followed up on the second day in the SPY, I think at record highs. And that's when we hit our new, that's when we started sliding down. And I believe we proceeded to drop for 4 or 5 days straight to the tune of around like 8 to 10%. And then obviously, the rest of the year was a wrap. It just wasn't a great year overall for investors. But this year, it's pretty funny. We gapped down after an initial gap open, or looking like we're going to open. We rallied back to fade today. And, the subsequent follow through so far has been gap up. And what's really been notable, Howard, is that there's been news out there that should have shook this market and slammed us down. Typically, if it was 2 weeks ago, we would have already been down 2% in, the Qs, but the bulls keep kind of just accumulating and ripping it back up, and sellers it looks like they're getting kind of surprised. So we're off to an inauspicious start, to say the least, where the control, which should be kind of perceived and deemed the most aggressive on the sell side. Actually, that hasn't been the case. The case has been that the aggression's been on both ends. And right now we're going through this tug of war. Now, ultimately, I do think the Bears are going to win out. We actually have a lot of Fed talkers coming up over the next few days. Bostic, Ballard, and a few others, or Bullard, I'm sorry, and a few others. But, if the market kind of absorbs and just rips us higher, there's a chance that we could actually see this market get really, really bullish going into Q1. And then that's kind of where I expect the shoe to drop. And so, I know you're not an economist, but you've been, quite fearsome of, the recession talk, and kind of already have seen the strong signs of it. You've pointed out plenty of times, and, I'm in agreement with you. How do you think this first quarter is going to play out for equities? You think it's going to?
Yeah, I mean, in general, as you know, I definitely am a big fan of macro. I do think it plays a big part, especially, nowadays, in the way that it is an outsized part, especially for crypto, where volume's gone down. So these little macro decisions move the market tremendously. I'm still firmly in the bank that we still have more downside, that people are just looking, people are just looking for any reason, traders, to sort of rally here right now. And then what happens is Bullard's going to come out, and they're going to come out tomorrow. I saw, how do you say Kaskari?
Kashkari.
Kaskari made it clear he thinks another whole percentage point needs to come.
I mean,
so they're talking about bringing that terminal rate up towards the higher end of what the projections were, right? And again, I think that lasts longer than people realize. I think that the people don't understand the difference between inflation starting to recede and inflation hitting 2%, where they start to take their foot off the pedal, so to speak. You know what I mean? I don't think they'll take their foot off their pedal, but before they put the brakes on again.
Yeah. So we had the FOMC minutes released today, and that was really important because the FOMC minutes really gave the market a pure clarity in relation to what the Fed dot plot was. And they talked about it in the last meeting, but it was really evident that no members expected a rate cut this year. And the market reacted pretty sharply to the downside. And again, we picked ourselves right back up. And that's something that we need to kind of keep in mind, because the last time that actually led to a 2% slide. Kashkari did mention that we're going to have 2 more rate hikes. He was talking about that 5% level. Again, the median's at 5.1. That does mean that we're projected to have 2 more smaller hikes, but nothing too crazy. And again, at this point, with the news already out there and those expectations, because of the dot plot, for those that don't know, the Fed puts the trajectory of interest rates and where they feel we're going to be every calendar year, and what the forward progression is going to be. And that's what the dot plot is kind of indicating, right? It's like a business plan, so to speak, right? So the median is around 5.1%. So that means a balance of somewhere between 5 and 5.25% by the end of this year. And it did show that there was nobody thinking that there would be any cuts. Some were projecting much higher. We're not going to say who, but we already know who. And those two also believe that in 2024, there wouldn't be any rate cuts. But that's 2 out of the 10. The rest actually believe that, or had already spoke on, or already forecasted that we are going to have these rate cuts in 2024. And it wouldn't surprise me that the first rate cut will come in the first meeting of 2024. Now, I will state that there's got to be something.
I'm sorry, could you repeat that?
What, the first rate cut?
Yeah, when?
In 2024.
Oh, okay. So yeah, absolutely.
First meeting of 2024.
I totally thought you said 2023. I was about to just walk off the set.
No, come on, man. We're only a couple days in here, man.
Well, that's why I was like, wait a second. That's it. Well, Charlie fell on his head during the holidays.
You also did cut me off right before I was going to say there is a situation where something extremely dynamic and extremely improbable has to happen, right? And that's going to be tied directly to the jobs market. It's going to be tied to our economic points, and it's really going to be something facilitated by the energy market, in my humble opinion. And that may be resolution to war, where it balances the energy prices. Energy, surprisingly, crude has been like tanking since the start of the year. I mean, they were down $3.71, and we're getting right back to that 70 level where, you know, Biden was talking about restocking the SPR. You know, this is now at a point where we could actually, if we actually see like certain things kind of come into play, the market could kind of balance out and the economy could balance out. And then the Fed could be aggressive or looking to temper rate cuts, but it's extremely unlikely. It's really unlikely because there's so many different factors that all have to like line up right perfectly for them to kind of change their mind, to change their tune and really change their attitude. Even though they're hiking at a historical rate, they had to do it. Inflation was quote unquote already raging at, you know, incredibly like inflated pricing in certain aspects. It would have just been really devastating, and it still could be a big fallout. Now, if I read clear, Morgan Stanley did not anticipate a recession for this year. Goldman Sachs said it's very unlikely we're going to have a recession. JP Morgan said that we're going to have a mild recession at the beginning of the year, but straighten out towards the end of the year. And I believe that the facilitator for all this partly is obviously the rising rates, but you know, again, if in the long run this is going to be a really good balance, then sure enough. So how can we capitalize on several factors here? A, market action, and B, market progression. I don't know about you, Howard. You and I have talked about a lot, you know, the long term a lot, and obviously tech is my forte. But I think one of the most unsung sectors that we're going to be hearing from is going to be in the financial sector and financial services. You know, JP Morgan, Goldman Sachs, Morgan Stanley, Citibank obviously stand out. I don't know if Wells Fargo or Bank of America will stand out as brightly because of how tied they are to the real estate market and specifically those ARMs mortgages that are, you know,
I'd
really
also
going
say Bank of America, you know, rumors here in DC have Moynihan as maybe the next Secretary of the Treasury. That would be a
that's
big
not
blow
good for
to,
Bank of America.
as I said, it'd be a big blow for Bank of America. That's exactly what I'm saying.
Right.
You know,
And again, for those that are wondering, Howard does have insight because he lives out there, right?
yeah, well, and remember the co-founder of ABCA used to be.
I'm sorry about your credentials. Yeah, plus his credentials. And
the co-founder of ABCA, up until 6 months ago, was one of the higher-ranking U.S. Treasury officials. So, got a little insight into
just a little insight.
Yeah, into there. So,
but I do love the sector. I think that once rates balance out.
Well, the other part that I was going to say, just to add to that, I'd add Visa, MasterCard, American Express. Exactly. Credit card debt at all-time highs. Credit card rates at all-time highs. That, you know, people are, you know, what it is, you know, where I see it. I mean, I can tell you because I'm still getting the offers. Every day I get another thing. Amex trying to throw a platinum at me. This one, I had a credit card up my without me asking, up my limit by $21,000. Like one day I look at him like, wait a second, how much credit do I have on this?
They want your money.
Like, you know, it was just one of those ones that I wasn't, you know, I never asked or anything else. So they're trying to, you know, they're pretty predatory, these financial service companies. As a crypto guy, I got to say that I want to make it very clear that I am anti the establishment. But, you know, so I do see them, in my opinion, quite honestly, they are, you know, trying to take advantage of this. You know, I really do believe that. I don't blame them. You know what I mean? That's the way to play the game. But, you know, so I do think the ones that are tied in there, we know Goldman, right, is Apple credit card and highly tied in there. You know, so I just think something to keep in mind. I also think, you know, hey, they make a lot more money on a mortgage at, you know, 8% than they do at, you know, 2%.
Absolutely. So with the credit cards, the only thing I wonder is how prepared they are for defaults, right? JP Morgan has over $9 billion in cash on hand, just held on to the side in case they face a series of defaults. The only thing that Visa and MasterCard that could kind of slow them down a bit this year is the DOJ investigation, and I don't really see much into it. I don't know. It may affect AXP as well, American Express. I'm with you though. I like the financial services there. I actually love fintech a lot this year. I love Block. I keep calling it Square. I love Block and I love PayPal. I actually think PayPal at the start of this year has been really, really, really strong. All things considered.
And I'll say, I'll bring up for those two the crypto aspect of both that I think is important to go over. PayPal just integrated with MetaMask, a Web3 wallet provider. A lot of talk there that they're going to provide the ability and the interface for some of these DeFi protocols like Aave for lending and borrowing, Uniswap for decentralized exchanges, that PayPal is going to try to tap into that. Be sort of try to make itself a super app across the DeFi and CeFi, because they'll take care of the KYC and the AML components of it. They already do that with their accounts. So I do think that is interesting. And as you know, with Block, Jack Dorsey stepped away from Twitter to spend his time on the Bitcoin business at Block. And they've got a lot going on, and they're going to, kick off some more and, more exciting stuff that they've already announced. Their look into Lightning Network. Again, I think you're going to see them. Not only are they well entrenched already in the financial service and fintech area, right? I think you're going to see them really move into the crypto space. They're going to start to fill the void left by these FTXs and, and provide that avenue.
I do want to talk about names that I do like this year. What's really interesting is the bear thesis, respectfully, the highly aggressive interest and activity of Apple and Tesla to the downside. Apple at one point overtook Tesla as the most shorted stock, which when I first heard, I thought was crazy, but now it makes sense. And a lot of people obviously want to see Tesla drown, but quite honestly, there's always been way more bulls and buyers in Tesla. That's why, Tesla and Apple were really two of the last big tech names to sell off. But here's Apple making new 52-week lows at the start of the year, and Tesla getting absolutely destroyed. I mean, they got to 104s here. And people are asking me how far the downside is. Well, if they don't hold 100, it's 91. If they don't lose 91, it's down to 60. And after 60, guys, their post-split COVID low pricing is in the 20s. So it's not like Tesla can't get there. Historically, they've gotten to this level. If we actually put it to a point where if we put it at split adjusted prices or pre-split adjusted prices, I mean, Tesla is getting to that point where it's getting, scarily close. They were, scarily close to that point where they were at peak. And this is where a lot of stocks started falling off when they dropped below that 2019, 2018 peak. And they hit those COVID lows. They started drowning back down. Amazon was one of those stocks where after their split adjusted price, I think it was at $80.30, and they got down to that range, and so far it bounced. I do like Amazon to the upside as well. So, for me, it's going to be a point of emphasis in recovery in the big tech names. And I got to be honest with you, as of right now, it absolutely does not look like it's going to be big tech. What I have noticed so far is that there's been a lot of early positioning in growth stocks. The names that kind of went absolutely stupid, right? That gained 80%, 90%, and they're off those levels just as much. Not so much in like cybersecurity, so to speak. And it's been weird in semis as well. Like, I don't expect semiconductor sector to do well, but Micron has been incredibly strong. Chinese stocks have come firing out of the gate. Baba's been exploding. Like Pinduo Duo PDD has been exploding. But I think the growth aspect is going to be very interesting in this environment because, with rates going up, it's obviously a negative for growth stocks because it's really expensive for them to borrow money, and that's what you need as a growth name. But as things get tempered, we may see that may be like, okay, well, now the bleeding is slowing down. Now, we got to start watching the ones that are keeping their heads above the water and still surviving in this environment. And those are the ones that we got to flood money into in terms of like retail, but most notably Wall Street. So that's what's interesting to me right now. Names like RBLX has been really strong, and Unity has been really strong. Peloton was getting high option volume to the upside. IAC, a name that's extremely underrated, but they used to own Match.com, et cetera. They're starting to catch a bid. Wayfair is starting to catch a bid. So I feel like these big tech names may kind of go back and forth and struggle, maybe with the exception of a few like Tesla, where I think Tesla could be the outlier, maybe NVIDIA as well. It looks like early on it's running into growth, maybe cloud services. We'll have to wait and see. Howard, Riot blockchain, by the way, just came out with news. Check this out. They said they produced 659 Bitcoins in December, up 55% from a year earlier. They said they sold 600 Bitcoins during the month for net proceeds of 10.2 million, leaving it with roughly 6,952 self-mined Bitcoins as of December 31st. They said also as of the 31st, it had deployed a fleet of 88,556 miners with a hash rate capacity of 9.7 or exahash per second. Riot is moving higher after hours here.
Yeah, I mean, again, another one that was at risk of bankruptcy. One thing we've seen, that sector has bounced back. They, the ones that it looks like are going to get their bailouts, they're getting their bailouts. You saw, Cores get money, restructuring money, and sort of came to a plan. Argo, right, and now Riot. So we're starting to see the distressed assets getting bought up by the companies like digital, or loans given by some of these companies and lines of credit. So, I guess that that's a good thing to see. Definitely a good thing to see. Good to see them holding some Bitcoin now. So they didn't sell, since July, pretty much every major public Bitcoin miner outside of Marathon had sold every Bitcoin they mined, because they had needed them to pay the bills.
Yeah.
So that's good to see.
I mean, today it's not like BTC went off, but what was really surprising is, I talked about it with you, is SI went nuts today. Coin went nuts today. Even a little stock named Tide, TYDE, which was a spinoff, I believe, of BBIG. They went nuts, and the Hut and Hive and a lot of stocks were around. Let me see, BTB. Yeah, BTB was rallying up as well. And so a lot of them were down, and then they started rallying up, and I'm not sure why. Coin at one point, maybe that's one of those growth names.
Coin is one I told you. Coin settled that suit with the New York Department of Financial Services, which is a big deal. It's going to cost them $100 million, but now people know it's off the books. They're compliant. That was a big deal because it was KYC, AML charges. So, that helps them. And I think it puts people feeling like they're in a good spot with regulation. That
makes sense. Yeah.
And I think it also let people know, since they got fined so much and they're considered to be one of the better actors, that some of the others are probably in more trouble. We know that Binance.us is, the SEC has a lot of questions about their acquisition. They weren't happy with their attestation reports, so they sort of are talking of not allowing them to acquire Voyager's bankruptcy stuff here in the US. So, I think that pushed Coin a little bit in that way. So I do think that Coin got that. We've talked about it. I mean, it does help. I mean, the other thing you'd have to look at is, did Kathy Woods buy another 1 million shares today or something? In all honesty, she's done a ton of Tesla. She might have been a big part of yesterday's rally. That it had. So I know that she releases her stuff, right? So if she did that, that honestly could be part of it. Wouldn't be that surprising.
It could be. I don't know. I actually do like Coinbase though.
Yeah, I told you. I mean, I think that they are well situated for everything that's going to come forward. I think they're going to be. I think there's going to be some winners and losers. I think that coin will be a winner when it comes to this new regulatory regime. They're one of the few that will have the experience and the
winner.
ability to to handle it. So I do think that they are, one of the ones to take a look at.
All right. So if we're going to bounce back here and let's say this market is bullish in the first quarter, which I don't think it will be, do you believe that the equities market's going to help lift BTC maybe back into the 18, 19 range? And maybe,
I mean, I think we're probably going to stay depressed down. We won't see that till about halfway through the year. I do think we'll see some moves up and down, but they won't be sustained. Could we hit 20? Absolutely could see a spike off of some kind of good FOMC report.
so you just think that every rally dies out?
Yeah, right now I absolutely do. I mean,
Okay.
I just, our volume, we just don't have the liquidity and volume moving it right now. So we need it in. You got to remember that they took out the market makers. The largest market maker was Alameda. They're gone. That's a lot of liquidity.
Yeah.
And now the Jane Streets and the Jumps and all those guys in Cumberland, they're all stepping back a little bit. You can see it in the numbers. Derivative volume used to be $100 billion a day. Now it's 25 to 40.
Yeah.
So, and that's not retail that left. That's the market makers. So, so I do think we have some time for that. That's going to happen. Again, I'm very happy to have Bitcoin trade sideways. It gives us a lot of opportunity within the alts. What I do think, and I heard a couple of good analysts today talking about it, I do think we only got about 5% more downside. I do think that, where you're calling for like Tesla that has, downside 95 and then it misses that, goodbye. I'm more looking at Bitcoin at that 14K as being really, really a strong spot for us. I don't think we see that sweep down to 10 that some are calling for.
So do you think that it's going to be alt season anytime soon then?
Well, I mean, again, I don't think anything's extended, Charlie. So I do think that everything's going to be rallies here and there. We just saw one on Solana jumped up 25% after losing, a tremendous amount first, bouncing back and seeing some stuff. Adams had a nice bounce back here. Litecoins moved up well lately. We're going to see 10, 20% winners, or moves, even 50% moves on coins. But, at that point, you want to be selling off because we're not done. I would think that you would probably say the same with stocks, right? You see something jump up 25%. Are you thinking that it's going up forever, or is it more likely going to, for me, it's going, everything is removed, it's a reversion to the mean right now on most things.
Yeah. Well, you and I know better. I mean, there certainly are names that could pump and get out of control. KALA has been one of them. My clients have done well, but I spend like 3/4 of the rally just warning people for the dump. I'm just like, listen, man,
exactly.
This thing's up $10 in 20 minutes.
And there'll be Doges and there'll be Shibas and there'll be others that, that are pumpers. They're similar to your penny pumpers. They're low volume. There's not a lot of float on exchanges. Everybody's self-custodying. So, if you've got, we just saw the guy, Avi, Everberg, whatever his name is, Avi, that's got charged by the CFTC. The guy used like $50 million to start that manipulation. It's not like these guys are moving, a few dollars. So, you could see it. I was looking at, look at the chart, pull up the chart for ETC USD, Ethereum Classic today.
TCUSD.
Well, I mean, that's its pairing. That's how it gone.
Oh, you're talking about on TradingView? I don't have TradingView.
You can do it on TOS. Do they have ETC?
TC. I don't know. I don't know what you're talking about.
Classic.
No, they don't have it.
Not so anyways, it pumped like 22%, but just to tell you the number, hold it one second. Its volume. Its volume on Binance is normally 57,000. With Ethereum Classics, it was 321,000 today.
Okay.
So, it's, 6 times its normal volume. So, well, someone in the room asked me about it. I said, probably, quite honestly, was one of those pump and dump groups, that you see on Telegram, because it's one of those coins.
Why Ethereum Classic?
Well, there isn't a ton of volume. I mean, that's not a ton of volume. $50,000 in volume. They throw $750,000, or 360,000 at it to move it significantly, and it moved up 18%.
Yeah. What's tough right now for both the stock market and the crypto market is that there are a lot of bag holders, and they're traders or people that took trades that ended up turning into bad investments. They're holding out for dear life. And so whenever we see these rallies, partly why, these rallies across the board start to die out is because people are unloading their bags, and they actually just turn into great short signals. They're called bag holder shorts for a reason. And
Yep.
So, that's just the struggles in the markets right now, is that the waves of selling are not just people trying to position to play the downside. It's people just trying to just get out from, a stock that they just hate looking at in their portfolio every single day. We'll see how this all plays out. Hopefully the Fed sends us like way higher here. Look, we're going to add these two as well. The rockets and the moon here, hopefully it sends us way up, both markets here, guys and gals. As we wrap this up, the one thing you're going to have to be prepared for is a lot of Fed talk, a lot of earnings coming out in this first quarter. There's going to be an extremely bearish tone, but if this market could kind of just hold up, we don't really need it to rally. We just need it to hold up through that madness. We'll see a pretty nice move going into summer. At least that's what I'm speculating. We'll have to wait and see. Howard, any final thoughts, my man, about the upcoming week for your markets, our markets, life in general?
I mean, not a ton of stuff moving on right now. It's just, nothing really.
I hope the Chicago Bears lose so we could try and secure the first pick. That's the only chance we can get. Second pick is just fine. Yeah. Hopefully this market gets going. All right, guys, we're going to wrap this up. If you happen to like our podcast, do me a favor, like, comment, subscribe, share, etc. Retweet, give us a shout. We would love to hear from you folks. I do get suggestions here and there. We'll talk about those topics more and more as we get involved. 2023, hopefully it's a big year. Hopefully, guys, we'll wait and see. Just want to say peace and love, and until next time.
See you guys next time.
This has been Dips to Rips with Howard Greenberg and Charlie Moon, brought to you by Prosper Trading Academy. Visit us at prospertrading.com to find out more. This podcast should not be considered professional, financial, and/or investment advice. By accessing this podcast, you acknowledge that Prosper Trading Academy LLC, PTA, makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this podcast. The information and opinions presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. PTA does not endorse, approve, recommend, or certify any information, product, process, service, or organization presented or mentioned in this podcast, and information from this podcast should not be referenced in any way to imply such approval or endorsement. The third-party materials or content of any third-party site referenced in this podcast do not necessarily reflect the opinions, standards, or policies of the PTA. PTA assumes no responsibility or liability for the accuracy or completeness of the content contained in third-party materials of the third-party sites referenced in this podcast, or the compliance with applicable laws of such materials and/or links referenced herein. Moreover, PTA makes no warranty that this podcast or server that it makes it available is free of viruses, worms, or other elements of codes that manifest contaminating or destructive properties. PTA expressly disclaims any and all liability or responsibility for any direct, indirect, incidental, special, consequential, or other damages arising out of any individual's use of, reference to, reliance on, or inability to use this podcast or the information presented in this podcast.